Hello, I'm William Pike, original author and currently co-author of Why Stocks Go Up and Down. The book was originally written as the outgrowth of a course I taught for the Boston Security Analyst Society, where the students were all people who were new in the financial community with no prior experience. Because they worked in the financial community, they needed a good grounding in the fundamentals, not the shallow stuff you got in most courses in those days. So this book was written so people would understand not just what was being talked about in the office all day, but what was behind it. The way to do this is to start with an introduction to financial statements. No one in the class wanted to be an accountant. I don't want to be an accountant, but if you understand financial statements, the more complex matters we discuss later in the book, cash flow, earnings, etc., will make more sense to you, and you will see what causes changes in earnings as it works through the financial statement, and that in turn will help you understand stock prices better. To explain what I mean by fundamentals, let me give you an example. One of my early students said to me, "Mr. Pike, if I buy a stock and I want to sell it, what if the company doesn't want to buy it back?" Well, this person clearly had a major misunderstanding of what the stock market is. When you sell a stock, you don't sell it back to the company, you sell it to someone else. But it shows you the common misunderstanding for people who are brand new. When you read chapters 5 and 6, we've learned about stock and about going public and what we call secondary trading. You'll understand that you sell stock to another individual or an investor, an institution. The company doesn't necessarily buy it back, although in a few cases they will. So people who ask me that question, when they read these two chapters, it doesn't answer the question, it makes the question go away. The question never should have been asked. They forget that they even asked that silly question. As you go through this book, you'll have more experiences like that. Things you'd heard a word used or a term that you're not comfortable with, as you see it in context and in perspective, I believe you become more comfortable with it. Another common misunderstanding young investors make is not understanding the difference between earnings and cash flow. They sound alike, but they can be very different. Once you understand the difference, you will suddenly have a perspective on when a company may or may not need financing, which will dilute its stock. I've just used a new term, but you'll be very comfortable with dilution after you have read chapters 4 and 5. Make that 5 and 6. It'll give you a perspective on why companies that are doing well, the stock may not go up because a cash flow statement shows they might need financing. That's just one more example of building your sophistication in investments. In chapter 18, we talk about price earnings ratios. What a stock is worth, the price it should be selling at, relates to its company's earnings, and we call that the price to earnings ratio. You've probably heard the term, but most people don't know what's high and what's low, and there's no answer to that. But in chapter 18, we give you a lot of different ways to look at it, develop a feel for it, have a perspective on it, and most people enjoy that chapter, but I encourage you to read the book up until that point first. One quick investment story. I'll call this taking my own advice. In chapter 18, I talk about when price earnings ratios seem abnormally high relative to the company's history, relative to the market, whatever, maybe you should consider selling. West Pharmaceutical, symbol WST, stock I bought many years ago. It's done well. It's up, 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 up. In 2021, the stock got over 300, and the price earnings ratio seemed ridiculously high. The stock had been doing well. It didn't seem like it should be a sell. There was nothing wrong with the company that I could find, but the price earnings ratio was so high, I just felt that the risk to reward ratio was out of balance. So I sold a little bit of stock, I think around 310, 320. Later in the year, it was higher. I sold some more, 330 or 40. then more 70. Stock went over 100. Of course, I'm kicking myself now. Now it goes, eventually it got over 450 and briefly, I believe, hit 484. Did I sell it all? No, but I kept selling more and more and more. And of course, I was angry. I thought I'd outsmarted myself. But then when COVID hit, the stock came down and ultimately went below 300. I believe it bottomed to 275 per share, but spent a lot of time at 290. In retrospect, all those sales at 300, 320, 340, whatever, turned out to have been good sales. If I remember to buy it back at 280 or 290, and I won't tell you what I did. Well, I will. I bought some back, but not enough, because now the stock's back to 340. The point is, when the stock was so high and overvalued, it just felt like a good decision to lighten up my holdings, take a little money off the table in case something goes wrong. I was not smart enough to predict COVID, but when it hit and took the stock market down, it took everything down. And because West Pharmaceutical seemed overvalued at the time, it got hit pretty hard. Thank you for listening. I wish you all good luck in investing. I hope you enjoy this book. If you do, please talk to my Korean partner, John Choi, and tell him what you think, and make suggestions. John and I have already considered the possibility of doing a follow-on book or additional chapters. We'd love to hear from you. Thank you.